Hi, I'm Tekoa Da Silva with Sprott Global Resource Investments, and I'm sitting down here again today with Rick Rule, Chairman of Sprott U.S. Holdings. Rick, as always, good to see you, sir.
Good morning, Tekoa.
So, happy to have you here, and I'd like to ask you about this idea again of market capitulation. You recorded a commentary on October 16th in which you said that, quote, "It's my belief now that we have a 50-50 chance of entering a capitulation phase in this bear market. If that's true, in the next few weeks, we will see 2 or 3 weeks of fairly dramatic, fairly ugly, but fairly short term of a sell-off. And this is consistent with what we saw in 92 as well as the bear market bottom in 2000, end quote." So, given what we've seen in the last 2 weeks of October, what are your thoughts there?
We haven't had the capitulation yet. I think an increase in the gold price probably, for the time being, forestalled capitulation. I think there's still more forces in the market which could take it lower in the short term than higher. I'm talking about psychological forces. We're in a very interesting situation. I think from a valuation viewpoint, the best 300 of the juniors out of a 3,000 junior universe are not merely cheap, they're very, very, very cheap. And so while the stage is set for a move to the upside from an empirical point of view, in the near term, markets aren't driven by the empirical, they're driven by the emotional. So any weakness that we were to see in commodity prices, in particular weakness that we were to see as a consequence of a strengthening of the US dollar, could push us over the edge again into the capitulation that I think is likely to be the condition precedent for a higher market. At the point in time when we were talking, we were beginning to see the types of market volatility, the types of rapid moves up and down with no volume that are normally the rattle of the rattlesnake of capitulation. But the market didn't follow through, and I think, again, it's a consequence of strengthness in the gold price.
So, if you were to say a probability of that, you still feel 50-50 chance?
I think so. I think the next excuse for the market to go one way or another is tax loss selling, which is an excuse for it to go down. And any move to the downside would likely, I should say, promote an emotional as opposed to a rational response. Understand that capitulation is a completely emotional decision. It's not an empirical decision. An empirical decision would be, once again, to sell the 2,700 nothing nowhere juniors that pollute the universe and buy the best 300. A transfer of weak investments to strong investments. We've already seen the transition from weak holders to strong holders. But we need that one emotional sell-off, I think, in order for the market to clear and move higher.
Speaking of it, excuses to sell, during that last week of October, I saw 4 newsletter writers, and we commented here a little bit internally that hit the sell button on the sector for various reasons, which I'd like to get to next. But when you see sort of wholesale buyers of junior stocks, such as newsletter writers, and they start hitting the sell button at the same time, instructing all their subscribers to sell, what are your thoughts there as you see that happen, and is there a capitulation that occurs there too?
Very unhappy outcome for their subscribers. Of course, very good for the market as a whole, because we need that market clearing circumstance. What I think needs to be remembered is that the newsletter writers are human beings too, and every human being is subjected to the same emotional response unless one employs real discipline. And the most important factor to note is that people's, and we've said this many times in the interviews you and I have done together, people's expectation of the future is set by their experience in the immediate past. And if all of your experience in the immediate past is getting punished, the expectation that you have in the future is that you're going to get spanked again. And in particular, if you're a caring person, a newsletter writer responsible for the fortunes of other people, the trauma that you feel coming up with good ideas and seeing your subscribers lose 25% in response to your good ideas is almost incalculably unpleasant. And the consequence of that is that the emotional turmoil that you feel yourself employing your own money is multiplied for them, because they go in this like politicians to be loved. And the fact when, despite their best efforts that they make, they're doing harm, it means that the impact on them of that fact, that your expectation of the future is set by your experience in the immediate past, is really multiplied. And that's the reaction that you see in the market. The spasmodic selling of a market that's already down by 83%.
In particular, Rick, I saw some heavy selling during that last week of October in response to a political event that we saw in Burkina Faso, which for our review there was some unrest related to a democratically elected president, if you will, that was looking to remain in power. And the segment of stocks with operations in that country were spanked down 20 to 50% in a matter of a day or two on newsletter writer sell recommendations. What are your thoughts when you see those types of events unfold?
Well, that brings up several topics of discussion. One is that utilizing newsletter writers for the market response that they generate, as opposed necessarily to for their advice, is a very good thing. If you own stock that is recommended by a newsletter writer, and the newsletter writer or an investment conference generates a response in the stock, you're wise to sell. Very often a newsletter recommendation can cause a stock to trade up by 25%. We call it newsletter syndrome. Using that response to sell the stock and then waiting 5 or 6 weeks until the response engendered by the newsletter writer subsides and buying the stock back can be a very good way to trade. I did it myself for years when my business was small enough that I had the time to do it. I can't do it anymore, but there's nothing to stop our customers from doing that. Conversely, a position in a company that's been held for a long time in large measure by newsletter subscribers that are suddenly advised to sell can cause a stock to come down by 25 or 30%. And what's really changed is simply the letter writer's opinion of the company. It doesn't necessarily mean that the company has come off. So utilizing sell recommendations by newsletter writers is still a technique that I employ. To the extent that I see a stock come off a lot that is on my acquisition list in response to the recommendation of a newsletter, certainly you study for the reason for the recommendation and you test it against your thesis. But if you believe you're right and they're wrong, they've given you a tremendous opportunity, a 25% off sale, which is very, very, very good. With regards to Burkina Faso, you need to be very careful about changes in political conditions in frontier markets. The reason that they're very poor, the reason that they're frontier markets, is that they're absurdly political. Political risk is smaller in very large countries like the United States, only because they're advanced countries and less political. The reason that the frontier markets are poor is precisely because they're so political. And so the importance of political events takes on an outsized character. With regards to what happened in Burkina Faso, the probability that the turn of events that people were talking about was going to be unpleasant for mining was very, very, very small. And so it's pretty obvious to me that the sell-off engendered an opportunity in stocks in Burkina Faso.
I spoke with a client this morning, Rick, about this particular issue, Burkina Faso, and he noted to me that he was reminded of the phrase that you can't read the scorecard in situations like that. And I'd like to ask you, what has been your experience investing in countries which, as you've said in the past, few people can spell, that have what look like obvious political problems at the surface?
My experience has been superb. That doesn't mean I haven't been hurt politically before. I have. But I'll give you an example. In 1996 or 1997, the situation in Congo would have been comical had it been not so tragic for the Congolese. The Congolese Civil War, and it wasn't really a civil war, that involves two different parties. The chaos that engulfed the Congo was absurd. You had, as headlines, AIDS, Ebola, malaria, and internecine conflict that killed 2 million people. The truth is that the mineralization, the subsurface mineralization in the Congo, didn't care particularly about the human chaos that was taking place on top. The copper in the Congo was emplaced between 35 and 45 million years ago in a complex series of geological events, and the copper didn't care much who killed who. And while that sounds heartless, I was powerless to stop AIDS, Ebola, malaria, or internecine conflict in the Congo. My charge was to make money for my clients. And I came to understand that in the Congo, the price of some of the best mineral deposits in the world, Kolwezi, Kapushi, Tanki Fungarumi, pardon me, was so cheap that I could afford to speculate in a binary outcome. I'm reminded that Tanki Mining, under the stewardship of the Lundin family, the finest mining entrepreneurs on the planet, holding the best undeveloped copper deposit in the world, was selling at 19, 20 cents a share with 30 cents a share cash. So you got to buy the best copper deposit in the world by the best stewards of wealth in the world at a discount to cash. And it occurred to me that I could afford to take a risk with money that I could afford to lose all of, because there were going to be two circumstances. Either Tenke Mining was going to go to zero, or it was going to go to $20 from 20 cents, pardon me, to some number like $10. Having the cash and the courage to make a binary bet in an extraordinarily bad situation, where the juxtaposition of risk to reward is 20 cents on the downside and $10 on the upside, is a set of circumstances that everybody should be lucky enough to have once or twice in their career. I have made those bets successfully in places like Congo, the Ivory Coast, Sudan, Ethiopia, Eritrea. I made the bet in Afghanistan and had the other experience. I lost all the money I put up. But certainly it's been a circumstance that has worked well for me. One of the things that I've been lucky enough to figure out is that part of the reality of political risk is perception. And in 35 years of investing in resources myself, I have learned that the most dangerous politicians are not the ones who appear the most odious on the evening news. They're the ones who are closest to you. The people that have the ability to get at your wealth, as opposed indirectly to wealth, are the ones that are of greatest risk to you. I've learned also that the greatest political risk I've suffered personally was here in the People's Republic of California. People like me, ethnocentric, Caucasian people, tend to confuse political risk. We tend to believe that money that's stolen from us by white people, according to the rule of law, is somehow less gone. An example would be when the Alberta legislature doubled the natural gas royalty in Alberta in response to rising natural gas prices 10 years ago. Having extracted front-end rents based on an old fiscal regime, they changed the fiscal regime. In other words, they stole $2 billion from shareholders. But being Caucasian, stealing the money in a legislative sense, according to the rule of law, made it somehow less odious than would have occurred had it been done in Africa by traditional methods.
Earlier in the month, I visited my local doctor here, and when I was checking in, I saw a map of Western Africa, and Liberia was on the map in red. And when I drove there, and when I drove home, turning on NPR, Liberia, Ebola, West Africa, constantly. And that's not, that's outside of work. Here all day, Ebola, West Africa. What are your thoughts there? Is there a bubble in fear, if you will, in the West African segment of the resource sector?
There is, and it will get worse. Ebola would appear to be a fairly irascible medical and social challenge, and those are fragile countries anyway, and ill-suited to deal with the challenge. And my suspicion is now we've seen Ebola spread to Mali, and it will likely spread further in West Africa, and as a consequence, fear of Ebola, which is already high, will continue strong. We will find a way to deal with Ebola. It might take 2 years, it might take 3 years. The experience that the commercial rubber industry has in West Africa, implementing social change among their labor force, and as a consequence of that, shielding their labor force from Ebola, is instructive of two things. It's instructive of the fact that private solutions to social problems are always better than social solutions to social problems, meaning that the private sector does things like protecting their workers better than the government does in terms of things like protecting their citizens. The second thing it points out, however, is that particularly in rural areas where you can control the local population because they work for you, the Ebola challenge doesn't have to be as serious as it has to be in urban areas in West Africa where there's a complete breakdown in social order. The third thing, of course, is that if gold in ancient Archean terrains in West Africa was emplaced 300 million years ago, and it takes 3 years to solve the Ebola problem, it's not going to matter to the gold. If the company that enjoys the gold concession is well enough placed that it can survive 3 years, the truth is that the fiscal regime in countries that are increasingly needy of the cash from gold mining will become better and better and better over the next 3 years. So people who have the cash and the courage to stay the trade need to understand Ebola in its entire context, a social tragedy, a political reality, a risk with regards to the gold mining industry, but certainly an opportunity for speculators.
What are your thoughts on the junior streaming and royalty sector here now, after observing the combination of Virginia Mines and Osisko?
Well, the junior sector is going to be, I think, stressed. The junior sector in royalty and streaming is going to continue to have problems competing with the bigger royalty companies. I would suggest to you that the combination of Osisko and Virginia isn't a junior, given that there's a $1.3 billion market cap, $275 million in cash, and substantial free cash flow. The big opportunity in streaming and royalty, as I see it, is the delta between the market valuations and free cash flow. The market values precious metals streams at something like 15 times EBITDA, which is another way of saying that the market is willing to accept a 4.5% to 5% yield on current investments with the hope of upsides either from precious metals or further discoveries. That same EBITDA, if it is on the balance sheet, or pardon me, on the income statement of a base metals producer, is at 5 or 6 or 7 times EBITDA. So cash flow in one corporate circumstance is valued at 15 times EBITDA, in a different circumstance is valued at 6 times EBITDA. And there's a $20 billion opportunity in the market right now for the big streaming companies that can afford to do $2 and $3 billion transactions to buy streams from base metals producers of byproduct precious metals production in transactions that simultaneously markedly lower the cost of capital for the base metals producers, allowing them to put the mines in production more cheaply, while substantially enhancing the visibility of free cash flow on a per share basis to the major mining companies. This is a $20 billion opportunity, and I see this opportunity being realized in the next 2 or 3 years. This is a catalyst to change the affairs and the valuations of the senior 3 streamers. The junior streamers will have to inhabit a different place of the landscape. They'll have to be more aggressive. They'll have to fund definitive feasibility studies. They'll have to fund development. They'll have to take on smaller, attractive opportunities, but they won't be able to avail themselves of the greatest single opportunity in the streaming trade that exists today, which is the arbitrage of this insane delta between the valuations of free cash flow as precious metals stream or as base metals free cash flow.
Rick, I heard someone ask the other day, how do I make money? How do you make money here? And it caused me to think about the process of making money. Do you make it when you buy? Do you make it when you sell? And what are the ingredients that are required to intentionally make money in a market as an investor, based on your experience?
I think you start by examining yourself and where it is that you make money. There's a bunch of ways to make money in markets. I, myself, am not particularly suited to trading. There was a point in time when I did more trading because I had less capital. But I am, by nature, now a capitalist, which means that I employ capital for the longer term, and a speculator in fairly grand size. And I have learned techniques that are suited to my personality. One thing that I am fairly unique about is that I understand that the process of speculation involves accepting failure. It involves an acceptance of the fact that 6 or 7 out of 10 of my decisions will end up being bad. And I accept 20 or 30% losses in 6 or 7 or 60 or 70% of my starts in return for 10 or 15-fold returns on the 1 or 2 or 3 out of 10 that become successes. I have also come to understand the admonition that I've given you so often, which is that you have to be a contrarian or you will be a victim. The truth is, in resource markets, which is what I assume we're talking about in the context of making money in speculation, what you need to know is, at least if you're Rick Rule, that you will not sell as much at the top as you should. A rational person will look at the fact, as I did in 2011, that there isn't much to buy, and interpret that, if they're thinking correctly, that they ought to be selling. Did I sell enough? No, I didn't. Hubris set in, and it will again, for sure. I think I'm a better analyst than the other guy, and I am. I think that I back better management teams with more discipline, and I do. I think that the balance sheets of the companies that I invest in are better than others, and they are. And I think the projects that my analytical team helps me choose are better than the competition, which is all true, and none of it matters when the market goes down. When the market goes down, everything goes off the bridge. And so the fact that I sold 30 or 40% of my positions at the market top doesn't excuse the fact that I held 60 or 70. And the 60 or 70 that I held lost me 50 or 60%. But the interesting part of being a contrarian is this. Once every 10 years, you experience a 50% decline in the value of your speculative holdings. And that's followed 4 or 5 years later by an upcycle, an inevitable upcycle, where you make 5 or 10 times, 5 or 10-fold return. So let's think about the arithmetic associated with that, okay? Let's assume that you start the exercise with $100,000 and you draw it down to $50,000. And then you turn the $50,000 into $250,000 or $500,000, which means ultimately what you did is that you turned $100,000 into some amount of money between $250,000 or $500,000 of money, or better. In my own case, it's been demonstrably better. Now, what part of this bargain don't I like? Of course, the part I don't like is the fact where it goes down, but the fact is that it's going to go down, and you have to accept that. And the earlier arithmetic people need to take into account. They need to take into account that if they're going to be speculators, not investors, speculators, most of the investment decisions that they're going to make are going to be wrong. They have to understand that you need to court risk in order to generate alpha, because it's risk that generates reward.
I want to ask you about this phrase that you mentioned to me one day, but you may have just well covered it, and that is you never, ever, ever get it right. And I'm thinking about that in terms of maybe for the viewer who is considering this market and maybe wants to, with their financial advisor or broker, add to their account in high-quality names. Is this a time that one would want to start taking bite-sized pieces?
I think so.
What are your thoughts?
I think so. I know what I get wrong. What I get wrong is I'm entirely empirical and entirely rational. And I'm lucky, not in that that's a fault, but in that I recognize my fault. My fault is this. I believe if this is true, 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 and that the result is this. I confuse two words, which is inevitable with imminent. And so I'm always too early. I'm too early on the buy side, I'm too early on the sell side. When I say you can't get everything right, if you are a good buyer, sometimes you can get a market bottom. But if your psychological makeup is that you're going to catch a market bottom, you're not going to catch a market top on the sell side. That's just the way it works. If you're a good trader, you're going to cut your wins before they've fully matured. You'll cut your losses too, probably, which is a good thing. What's more important is for people to understand their own emotional makeup and how their own emotional makeup is going to govern their actions in the market, and attempt to compensate as best they can for their psychological makeup by a disciplined plan of speculation which will enable them to use their own skill sets but their own prejudices to their advantage as opposed to being disadvantaged by who they are.
We chatted about this in our last interview, but if the viewer is joining us for the first time, what's the biggest risk that the investor faces and how can they mitigate that?
Simple. Biggest risk is to the left of your right ear and to the right of your left ear. Not Obama, not the gold price, nothing like that. The biggest risk is not being able to work hard. The biggest risk is got a hunch, bet a bunch. The biggest risk is going into a speculation without a plan, not knowing why you made the investment, not knowing what would cause you to sell, both in terms of success or failure. Indiscipline is a big risk. If a stock goes down, does that mean that you sell it reflexively, or does that mean that you knew enough about the company going into it that the fact that it sold down allows you to re-examine your premises, see if you were right or wrong, but buy more if you think you were right and the market's wrong, because the market's frequently wrong. Remember that making money in speculation is taking advantage of the delta between opinion and fact. It's been said by many knowledgeable observers that the market in the near term is a voting machine. In the long term, it's a weighing machine. And speculative profits are the delta between the way people vote, which is always stupid, and what stuff weighs.
Rick Rule, Chairman of Sprott U.S. Holdings, thanks so much for sharing your comments with us.
Thanks for the opportunity.